Hey guys, what's going on? Kunal here, Bulls on Wall Street. Want to talk to you guys a little bit about the pattern day trade rule. This is one of the most asked questions I get on my YouTube and my email. People want to know what it is and, you know, what can they do so that it doesn't impact them in so much of a way every day. And so the pattern day trade rule essentially for day traders states that you have to have over $25,000 in your trading account in equity or cash to actually be able to day trade freely, making it so that you can do unlimited day trades, right? So it's like, you know, you're trading all day, right? Like somebody would do for a living. You can't do that with less than $25,000. You're limited to 3 day trades a week. And if you do more than that, what ends up happening is that you can get your account frozen or suspended from making any more day trades for a period of like 90 days. And usually a lot of these brokers will reset it one time for you, but otherwise beyond that, it's nothing. You know, they freeze it and so you can't make any more day trades and you're just stuck. And I know how nerve-wracking this can be because like when I was a new trader, they didn't even have the pattern day trade rule. And then after the market crashed, they put it in. And so I had to adapt to it a little bit. And what would end up happening is I'd have like a couple positions and, you know, I'm always taught like manage your risk, manage your risk. The risk is the most important thing you can do. And so you've got a couple positions and the market starts going down or, you know, your stock starts to tank. And you don't want to sell it because you don't want to waste one of your pattern day trades, right? And so it's like a juggle. You're like, I know I should sell it, but I don't want to waste a day trade because then I can't trade the rest of the week. Or, you know, it's going down and you're like, well, it should bounce here. And it just gets you in a whole different frame of thinking. You know, as traders, we're taught, right? Buy, set your stop, let it rock. And so now when you have this thing kind of influencing how you trade, it can screw you up because you're not trading with the same rules that everybody else that trades for a living is. And so how do you get to the point where you can get there? Well, there's a handful of things you can do. And I think it's important because one of the reasons that so many people get into like stuff like Forex and futures is they're trying to get around the pattern day trade rule. They want to go and take like $200 and throw it in some bullshit Forex account and have like 50 to 1 leverage and they think they're going to make all this money. And it doesn't work like that. In trading, you need a few things. You need the skills. And you need the capital. And when you try to shortchange one or the other, you get awful results. And so what happens is a lot of people get into these kind of niched areas of trading and only to get around the pattern day trade rule and just have small amounts of capital and they think they're going to make big. And so I've traded Forex before. I'm actually pretty good at it. It's not my specialty or where I focus, but it's a legitimate way to trade if you're good. But it's not the cleanest of markets to me. You know, the Forex brokers are always a little bit more shady. You always have weird fills coming in on these things. There is a value to it if you're actually having ideas of directions of currency and you have a thesis. Like, you know, I've had different theses like since Trump went up, the U.S. dollar is going to go up versus, you know, X, Y, Z. And so, you know, these are kind of longer term plays that I can do. But a majority of people are not getting into it because they want to trade that. They're just getting into it because they have $200 and they think they can be a trader. And that's not the case. You need more than that, right? You need the skills, you need the capital, and then, of course, you need some tools. And so equities, I think, and futures is pretty good too. Equities, I think, is the best spot for a new trader to come in and learn because you have some rules and things to protect you, of course. But most importantly, it's the funnest, I think, also. It gives you the opportunity to look at different stocks every day, find out which ones are going to be the high flyers, and really get into it. But, of course, you have this thing. You got this damn pattern day trade rule. So what do? Well, a couple things. Number one, when I started trading, and I was trying to build up my account, I did it as a swing trader. When I really got good, I was swing trading, meaning I was holding stocks for multiple days in a row. You know, I tried day trading, I just stunk at it, and then the PDT was killing me. I'd have these stocks I want to stop out on, and then boom, right? I'm playing the PDT versus playing the stock, and that was no good. The second way to really do this beyond that is maybe split up your accounts. So for a while I had a bunch of $2,000 accounts so that I could get 3 day trades in each one. But that one, it worked for a certain period of time, but it's easy to lose focus when you have multiple accounts coming up. Like imagine you need 3 damn computers for your $6,000, right? It's a little bit crazy. You got $6,000 in computers and you got $6,000. To me, I'm not sometimes the most focused person in terms of being organized and being like, oh, I got this and this account and this account. And frankly, it was hard for me to keep track. Another way is to join a prop firm. There are prop firms out there where you can go and get licensed and trade at a firm on their floor, places like S&P Capital or T3. You can go in there and it's like you're getting a job. They'll come in and hire you and they'll train you. And if you're good, they'll give you access to capital and things like that. I have something similar with my hedge fund. I have 150 students that I've trained in there that trade with my tools and the capital that I've given to them. And I give them, of course, really low rates. And we put in enough capital and things of that nature so that they're not hit with the PDT rule. And what we do is, as they get better, I keep giving them access to more cash to trade with. And that's how you can start growing your profits, right? A lot of people want to just grow their profits from taking more and more risk and bigger positions. But the best way to really grow your account in terms of how you're going to have like bigger plays, like how do I go from making $100 trade to $1,000 trade? Well, grow your account, right? If you have a $2,000 account and you go to a $10,000 account, you inherently are going to have bigger positions. But where a lot of people screw up is they start taking the bigger positions when they just have the $2,000 account, and it doesn't work like that, right? The best way to do it is just to incrementally step your game up slowly. I always think about this in business and also in trading is how can I put myself in the best position to grow for the long haul? What's the best for my career? And that usually means no big shortcuts and no monster risks. Of course, you have to know when to push your chips in the table, and I've done that numerous times in my career where I said this is a special moment or a special opportunity where my risk is low and my reward is really big, but I don't do that every single given trade, right? And so something to kind of keep track of. I'm going to do some slides here and kind of go into the details of what the PDT is and how it came about. I know a lot of you guys have asked me to do updates to the Bulls on Wall Street course book. This is the Trading Bible, couple hundred pages of everything that's in my brain. I have the update coming up, so hit me up whenever. I'll hit you guys up whenever I'm done with it, but obviously the first course book is amazing, and I'm just touching it up to make it a little bit more pizzazz, and of course, markets change, and some of the tools I use change, so I'm adding a little bit of juice to it. Guys, I'm going to get on the webinar, and we're going to talk about this and get this thing going. Hey guys, what's going on here? Let's get into this. So what are the details of this pattern day trade rule? So pattern day trade rules implemented after the market crash in 2001 when a lot of day traders lost money. The purpose of the rule was to limit less savvy traders from over trading and losing their money in big moves. I traded through the tech bubble, and it was a wicked. You guys thought that 2008 was nasty? I mean, the tech bubble had stocks that were just soaring, right? Stocks that were just junk, that were $400, $500, and of course I was just a kid, so it's not like I was really making any serious moves or anything, or even knew what I was doing, but I was trying, and I got to kind of play some of the up and then all the down, and I didn't even know there was anything called shorting at the time, so I didn't get to capitalize on it. But after all that, this PDT comes into place, and what it does is it states that any person who makes more than 3 day trades in a 5 day period must maintain a minimum account balance of at least $25,000. A day trade is simply defined as buying and selling the stock within the hours of 1 day. So say you're trading Tesla. You buy Tesla at 220, and you sell it at 221, that's a day trade. If you buy it at 220, and then you sell half at 221 and half at 222, that's still going to count as just one day trade, okay, because it's still one round trip. Now, where it gets tricky, and this is where it got me a couple times, is if I scaled into Tesla and I bought at 218 and 219, and then I sold at 221 and 222, that's 2-day trades. And so that's where you got to be careful. You're doing multiple buys and multiple sells in the same stock, you can still get hit with the pattern day trade rule. A day trade, remember, 2 buys, 2 sells will count as 2. Okay, and so always try to match things up. If you buy one time, just know that you're getting a day trade on you. And so you can sell that thing as many times as you want, but you can't buy anymore. Swing trading it, which involves holding stock overnight, does not fall under PDT. Okay, so like one of the things that I was doing when I met Paul, my mentor, and he taught me swing trading was, I would make sure to get my watch list ready, and I would stock some of these stocks for days and days for the perfect entry, and I would typically buy them towards the end of the day. That way, I would have a limited amount of time for them to go down, and then the next day, right, your pattern day trade rule is not on as you bought it the day before, and then I can let it do what it wants. Because during turbulent market times, so I traded during some real turbulent market times. I mean, the 2008 crash, the telecom bust, all these different things. And one of the things that I used to do is I love trading the mornings. So I'd buy the stocks in the morning, the first thing, and then guess what? I got all day for that thing to go up or down, and then sometimes I'd have to, sell it, even my swing trades, and then it would count as a day trade. And so, I tried to buy them towards the end of the day, not always, but I tried to buy them towards the end of the day if the setup was there, of course, to impact that in case I have to stop out. The PDT impacts everybody in these different ways, and so just something to always keep your mind on. To understand how this affects you, we must first define some terms related to brokers and brokerage accounts. So, settlement period. You guys see this on your brokerage statements all the time. What's the settlement period? When you make a trade, it can take up to 3 days for the funds to settle. During this time, your funds are not available to be traded. You ever buy something and then you sell it and you're trying to buy something again the next day and it's like, it'll say you don't have enough cash and you're like, oh my God, I got $5,000 cash in here. Like, I'm not holding any stocks. Like, what's going on? Well, it's because your trades haven't settled yet. That's what happens when you have a cash account, okay? A cash account is not subjected to PDT because it takes days for your trades to settle, and so it's not like you're going to be trading back and forth anyways. You're going to just make 1 or 2 trades regardless. But when you have a cash account, that's when you get the settlement restriction. So how you don't have the 3 days to settle is you have to have a margin account. The margin account is what almost all day traders will use. And what that means is the broker gives you a credit. So say you have $5,000, you buy and sell something. Rather than wait for 3 days for it to settle, your broker will just credit your account $5,000 because they know you have $5,000. It just hasn't settled, and then you can keep trading with it, right? So you can go back and forth and back and forth. So essentially taking a small loan for a couple days from your broker, okay? But when you have a margin account and you're on credit with your broker, that's when you get the PDT. So there's really, they both kind of have their own little nuances, and they both kind of stink in a way. So the margin account, you can get your money back quicker, but you got to have $25,000 a day trade, or you're just limited to 3 in 1 week. A rolling 5-day period. So don't think like Monday to Friday or Tuesday to Sunday. It's a rolling 5-day period. Buying power. This is the amount of margin borrowed you are allowed to use. For day trades, this generally means you have $200,000 worth of buying power with a $50,000 account. This is very powerful as it allows you to make many day trades throughout the day, but also use more money than you have, right? I know a lot of people feel weird about leverage. I don't like leverage in terms of like the kind of
4x type of leverage where you get 50 to 1 or 100 to 1. That's risky because one bad trade will bust you. But throughout business and history and trading, leveraging of time, leveraging of people, and leveraging of capital is how you grow a business. And you guys are the CEO of your own trading business. So selectively, there are going to be opportunities where you may use some extra buying power more than the cash you have if the situation is right, where your reward is big and your risk is small. But the way you have to look at it is like this, okay? Say I have a stock and I have like a $10 stock, right? And I have a $100 risk on it. Like I want to risk just max $100. That means you can have 100 shares. Now, that same stock, maybe you're day trading it, so you have a way better entry. And that $10 stock, you have a $9.90 stop loss. So you're only risking 10 cents on it because you got a way better entry. And it's just a quick day trade. Well, guess what? At that time, you could still risk $100, but you could have 1,000 shares. So you would have a lot more shares and use up a lot more buying power, but your risk would be the same. Where people mess up, though, is they go in bigger size and use more margin, but then they also increase their risk. You only want to use the buying power if your risk is still following the parameters of your account and is small, and you have that great entry and you're able to manage getting in and out. And I never hold on margin overnight. You know, I strictly use buying power or margin for day trading. And so that's how I can use leverage and things like that sometimes, because if you're holding a stock, like today I shorted this NVIDIA. You know, it bounced down from 108 to 102 and it spiked up to 107 in the next candle. I nailed the top at like 106.50s or something, and then I was covering down 104, 103, and so that's a $100 stock, right? I mean, it's expensive, but it has a big range, and so I'm using margin because my risk was only 50 cents on the trade. You know, it stopped at 107. I shorted at 106.50, so I was risking 50 cents. And so I can have, I'm trading a $2,000 account in front of my students right now, showing them, you know, how to grow it. You know, I can have 100 shares or 150 shares because my risk is just 50 cents. You know, I was risking between $50 and $75, give or take, you know, where I get out in my fills on it. And so even though I use a lot of buying power, I didn't necessarily use a lot of risk, okay? And so that's something you always have to match up. Don't use a lot of risk and a lot of buying power. That's the perfect storm of despair. If you want a day trade, remember, you're going to need that margin account of at least $25,000. Because if you violate it, you're going to be warned by your broker. If you do it again, your account's going to be frozen from making any more day trades for 90 days. So they won't freeze your account and take all your money and stuff like that. That'd be a little crazy. But they're going to make it so you can't buy and sell in the same day for 90 days. They're going to take away your margins. You're basically running on cash account style. And so now you're back to rotary style, right? Wait for your 3 days for your trades to clear. It gets a little bit crazy. So what are the risks? Well, margin and leverage, when it's good, is good. But in the hands of the uninformed, the unintelligent, or the undeserving, the margin can be a detriment. You know, you have to earn the right to use margin. That's what I tell my students. You got to earn the right to use the margin. You got to go on the simulator and prove you know how to trade. Then you got to trade really small for a period of time, maybe 50 shares, 100 shares of everything, and show that you can be profitable. And then you got to earn the right to take it to the next step. You got to earn the right to take next step. And right, even being a day trader, like this job is amazing, but I got to go out and earn the right to be a day trader every single day. It's a privilege to do it. And so we can't use the tools and the power we have unwisely and recklessly, because we want to be doing this for the next 10 years, 20 years, 30 years. Look at me, man. I've already been doing it for 15 years. I feel like I'm just getting started, man. I still have that passion for it. But the margin, it multiplies your profits, but it also can multiply your losses in the hands of somebody unworthy of the power. That sounds so Lord of the Rings, doesn't it? But for example, say you have 120,000 day trading power in your 30,000 account. A 5% drop will mean a $6,000 account and take you below the PDT, wiping out a huge chunk of your capital. And so a 5% drop in your margin that you're using because you're all in, it really results in 20% of your capital. And so we can't do it like that. If I'm risking $500 on a trade, then I can use my day trading buying power, and I may have 60, 70,000 in a stock, but I'm risking only that $500, right? I can't take a $6,000 loss. I can take a few $100 loss. For a $30,000 account, a safe way to play it is maybe risking 1% of your capital on the stock. Not meaning you only put $300 in, right? But what you're saying is if I take a loss on the trade, I'll lose $300 or 1% of my $30,000 account. So you got to always play tight. And the reason I like doing that is that you have to be wrong, and I'm just using ambiguous mathematics, but you'd have to be wrong 100 times in a row, right, to blow up your account. And I know there's fees and taxes and all that fun stuff, but theoretically, that's how we want to look at it. What are the odds of being wrong 100 times in a row? Very, very small. I mean, for me, right, what are the odds of even being wrong 5 times in a row? Very, very small. And so risking that 1% kind of keeps me in the game. Now, if I'm trading hot or I see a pattern that is one of my go-to setups, something that I know I hit with a high win ratio, a high reward ratio, then maybe I risk 1.5% on that trade or 2%. But only in those rare occasions do I do that. This is doubly true with shorts because you're obligated, remember when you short, to buy back the stock regardless of how high it goes. Your losses are theoretically unlimited. So going on margin and then holding a short, your losses are going to pile up really fast. Now, of course, all losses are theoretical. You stop losses, right? I short something at 20, my stop loss at $20.50 or $21, right? Manage your risk. Losses are, of course, unlimited if you're not looking to manage your risk and you just let it ride. I had some students do that, man. They get frustrated and go, I'm just going to let this thing ride, and see if I can get my money back. And it's the same thing. Hey, you know how that goes. A couple times you get your money back, but it only takes that one time where all the money's gone. How do I navigate the PDT? So let me show you an example of some of this too, in terms of shorts, because I had some students of mine, I had one student of mine kill this, but I had a few students that really kind of mismanaged some of these stocks, and when they're shorting especially, it can be really tricky. So we have, if you guys remember this, this is like Trice. This is a stock that, it's always been a turd, right? This thing's like at $3, just a huge turdzilla, really. It always kind of hangs out in the same area. And, I had a PR out, and the float on it's really low, and we were day trading it. I was day trading the upside for a few days, and I stopped once it got day 3. I don't like when they get extended and they get to day 3. I feel like I lose a lot of my edge because now the stock is getting extended. So, you saw people day 3 start to short this thing. And you can see what happens is, you start shorting this thing, and, right, these things can keep going higher and higher sometimes. And so you have to be able to manage your risk. I don't like holding shorts overnight, and I don't like going big margin on them if they're flying like that. I'd rather wait for them to top out and then start hammering them to the downside versus trying to catch it to the upside. Kind of like this NVIDIA. This thing, this thing has been like this huge trender for a long time, right? And I caught the short in it yesterday. So it was a 1 day, 2 day, 3 day, 4 day, 5 day, 6 day. Everybody thinks it's a short at 100. And it goes up, all the way to 120. And to sit there and just keep shorting it because you think it's high is crazy, right? And so, I wait till it essentially gives me the signal that it's reversing. And so it does an opening gap reversal yesterday. And so I start shorting some of this at 118. And then now I have confirmation. Once this thing does an ORB setup here, that's like a mini flag at the open, I short some more, and I'm adding on that confirmation. And so now I get this huge flush down to 108, right? And it's just cover, cover, cover. That's your opening setup. And then later in the day, as it starts to bounce, see, this is a bear flag. It's a breakdown, pull back into VWAP, red candle to hold. Once it cracks that trend line, I'm shorting this thing back down to the low of day. So it's like 114-ish, 113.70s. But that's how you got to do this, is really make sure that we're waiting for the right opportunities. And so when I see the signal and I see the pattern, then I short. And I only do it with minimal risk. Like when I shorted this thing here, my stop loss goes right here. So I'm only risking this much versus, right, this endless barrage of things. And so if I'm only risking this much, well, then I can use a little bit of margin and a little bit of buying power because my risk is just 30, 40 cents, right? You could have 1,000 shares and it would just be a $400 risk. And that's okay. That's in my wheelhouse, right? I can do that because my risk is managed. So just something to kind of be careful of when you're doing these is always think about, what your risk is on these things. So how do I navigate all this? Well, first you got to have the right type of account, a margin account. You got to maintain that balance of 25,000. If you don't have 25,000, you get a swing trade, right? Swing trade and build your account. A few $100s at a time, $500 at a time, having really good swings where you take the chunk. You could split up your account and have a couple different accounts go. You may have one for your personal and another one in your IRA, and you're kind of swing trading these together. Or, right, get backed. Find somebody that's going to back you. Either a firm like mine or a prop firm. There's some amazing ones out there besides, the stuff I do. SMB Capital, I know those guys pretty well. T3 is one of the more well-known people around. Of course, that's a lot of work, too, because now you got people just up on your ass all the time, right, managing you and trying to coach you. And so you guys don't want to be coached, right? You think you know it all, right? And so everybody's a little bit different. Most of my students, they like the hands-on approach that I provide because everybody needs a mentor sometimes, right? Even I have mentors. Practice good risk management, set in on your stop losses, and know when to scale out and size your positions appropriately. Have a trading strategy. Learn how to identify and trade profitable chart patterns. Guys, having a methodology is the most important thing. Forget all this PDTs and buy short. I don't have any capital. I have capital. I don't got a good family. I don't have this or that. Everybody's always focused on, what they don't have. Remember that most day traders start with very little money anyways. They have to build it up. They have to save. This is what I did, and this is something that could be a roadmap for you. I had this little game I played. So I had an ACH hooked to my trading account in Ameritrade. And so anytime I gave something up, I used to like to go to Starbucks, right? So if I didn't go to Starbucks, I'd ACH over $5. Even $5. I used to have like these beer nights with my friends, like where we'd eat wings and talk about not getting any chicks. And we would do that like on Tuesdays. And so if I didn't go, I'd put $30 and I'd ACH it over. If I had one year I skipped New Year's, my friends were going out to get a limo or whatever. I said, you know what, I'm going to stay in. I got some work to do and I want to save the money. And so I transferred over $300 to my trading account. So I had a small account and I was swing trading and growing it and taking selective day trades. And then I'm ACHing over money. And you'd be surprised how much money you can save. It could be almost $1,000 a month in just all this random stuff. And so guess what happens? Now, over the course of the year, you've saved yourself, say, maybe $10,000 in just limiting some of the extracurriculars that you do. And I know it sucks because everybody always says, well, you got to live life. And it's like, no, you don't. You have life to live, but you don't have to do it right now. You have to get shit done at some point, right? You got to get it done. And so I had a long-term vision and plan that I'm going to save the money and build my account. And so, mind you, you save $10,000 that year, and then maybe you make $5,000 or $6,000 from your trading and your swing trading, right? You grow your account, and then guess what happens the next year? You're still saving your money, and now you've got a much bigger account. So now by the end of the year, maybe you have 15,000, 20,000, and now you're going to make say 10,000 in your trading or something like that, and then you're going to save another 10,000. Well, guess what happens after 2 years? You got 40,000 bucks. Now you have a nice chunk of change that you can actually trade. Because if you want to be a full-time trader, you want to be a real trader, you're in this for the long haul, then that's what you have to do. You have to have the 2-year plan. And you've got to go and start with your small account and grow it $100 at a time. And then you got to keep saving money because there are no shortcuts. And that's how I made sure I only had to go through it once. I didn't have to go back and get a job. I just had to do it the right way the first time. So guys, I hope that helps. Let me know if you have any questions or anything like that. Remember, no shortcuts. Save money each month. Cut out all the fat. Keep growing your account. And over time, expand your mind, your skills. Slowly grow. Slowly save. And you'll get there. I'll tell you what, you'll definitely get there. You just got to do it and take the long view. Take care, guys.